And today is yet another historic milestone for the Fed. It marks the beginning of its program to purchase corporate bonds and the ETFs tracking them. The buying targets fallen angels downgraded as a result of this pandemic. And since the Fed announced it would buy corporate bonds, there's been a massive wave of debt issued, more than $500 billion. And at a breakneck pace, year over year, this issuance has almost doubled. Let's bring in Winnie Cisar. She's head of credit strategy at Wells Fargo Securities. Winnie, it's great to see you today. And perhaps most interesting to me is the fact that spreads still are pretty wide by historical standards. So this program has started to help, but it suggests there's a ways still it could go.
Yes, I definitely think that there is a ways that it can go. IG spreads are still north of 200 basis points. We consider that stressed or recession-like territory, which is absolutely appropriate given what's going on in the broader economy. So Fed intervention so far, or at least anticipated intervention until today, really supported the segments of the market that the Fed very specifically said it was going to start to intervene in. That would be the front end of the high-grade corporate credit market, and then also a backstop to some recent fallen angels. Now, as the Fed program actually starts to make its way through the corporate credit markets, it should incentivize investors to start looking at some of the sectors and capital structures that maybe had been pushed to the side for more of those easy kind of first investment opportunities in all of the volatility that we saw.
Right. You know, one of the questions that I have is they could have just bought these bonds outright, and in some cases they will be. Why buy the ETFs? You know, it's quite an endorsement of an instrument that in some ways is still very new and that a lot of people don't always fully understand. I don't know if you want to kind of get into the physics, the engineering of it, but does it make sense to you that they would use an equity instrument in order to provide relief here?
It does make sense in some ways. The ETFs are by far the most liquid instruments that are related to the corporate credit markets. Trying to actually set up a program where they are intervening in the credit markets and purchasing bonds outright in the secondary market, that will have very specific benefit to specific tranches and issuers as the Fed kind of makes its way through that program. But in terms of setting up the program from a logistical perspective, I would expect that it was much easier for the Fed to say, okay, first let's focus on where we can inject liquidity into this market in a very efficient and straightforward manner. And then as we move down the pathway in all of our different programs that we're setting up, we can start to expand the territory, expand the universe, and actually wade into the secondary market.
That's a great explanation. It leaves me wondering about one issue at the heart of all of this, which is the Fed picking winners and losers? And is that inevitable? So, yes, an ETF kind of helps them avoid that problem, but at some point they will be buying these bonds directly. Have they made their criteria clear for, who gets support and who doesn't?
So I think that so far they have made their criteria clear for who gets support right now. But as we've seen, the Fed has been willing to evolve their programs, not just the corporate programs, but the whole range of tools that it has announced in the COVID-19 pandemic to identify parts of the market that are not having proper liquidity being pushed into them and kind of retool their strategy to adjust. So for right now, what I think that the Fed is trying to do is say, listen, there was a whole universe of corporate debt that was what we view as creditworthy and or fundamentally sound heading into this pandemic. Our first key issue is ensuring that these borrowers who were creditworthy, who were solvent heading into the pandemic, remain that way. They don't want to see investment grade companies all of a sudden running out of cash flow and being forced into some sort of default or restructuring situation only because of the COVID-19 pandemic. Now, at the other end of the spectrum, there were a number of capital structures that were already pretty high leverage. A restructuring, a default was likely to come at some point. Was it necessarily going to be right now? No, probably not. Maybe in the next 6 to 12 months. So now we're effectively pulling forward those defaults.
Mm-hmm. And I noticed you guys even upgraded your energy sector to market weight from underweight again, maybe on some signs of stability in the oil patch and on some of the support too. Winnie, thanks so much. It's good to speak with you and kind of check in on how this is all working. We appreciate it.